Have you ever wondered if you could buy a multi-million-dollar business with zero money out of your pocket? Well, that's exactly what we're doing. And today, I'm going to break down exactly how. My partner and I found an exciting opportunity, a short-term rental property management company in the northeastern US with about $5 million in revenue and $3 million in EBITDA, about a 60% profit margin. The company has been operating for over 5 years with 40 plus staff, managing several hundred rental properties. It's a market leader in its area, overseeing roughly 5 to 10% of all short-term rentals in its 3 key markets. We see big potential to expand into new regions by hiring a sales team and aggressively growing the portfolio. After some hard negotiating, we agreed to buy this business for $9 million. That price is roughly a 3x EBITDA multiple, which we feel is fair given the assets are mostly intangible. Essentially hundreds of management contracts with property owners that can be cancelled at any time. Recurring revenue is fantastic in this business, but if the rentals aren't managed well, owners could walk away. So there's some risk. The seller initially wanted $12 million, a 4x multiple, but we pushed back because of the contract cancellation risk, and we settled at $9 million. So far, so good. We have a deal. Now here's the catch. We don't want to put any of our own cash into this deal. In fact, my client, the operating partner in this buyout, had recently tied up his liquidity in a large real estate development deal. So he's very light on cash. That means we need to get creative and use 100% debt financing to close this acquisition. So how on earth can you buy a $9 million company with no money down? Let's dive in. The first problem to solve was the down payment. Traditionally, lenders, especially banks, want to see the buyer put in equity, often 10 to 30% of the purchase, as skin in the game. In our case, 30% of $9 million would be 2.7 cash, which we did not have available. We're essentially doing a leveraged buyout where we aim to use the company's own cash flow to finance the purchase. Our goals are to minimize upfront cash, avoid putting in personal funds, and avoid signing a personal guarantee on the debt. We want our downside risk to be limited to the business itself and not put our other assets at risk. Why do we hate personal guarantees so much? Well, it's a philosophical and strategic choice. We own and acquire businesses to build a diversified portfolio of income-producing assets. Each business is in its own LLC, and we want each to succeed. But if one falls, we don't want that failure to drag down our entire net worth. A personal guarantee means if the business can't pay the loan, we are 100% on the hook to pay it from our personal assets. A much better option for us is a non-recourse loan, which means the lender can seize the collateral, so the business's assets, if the loan defaults, but cannot go after our personal assets for any shortfall. It keeps our liability siloed to one investment. What this means in simple terms is if the business fails and we can't pay back the debt, God forbid, we're willing to let the business go to the lender, but we're not willing to risk our homes, savings, or other companies. This is a core principle of how we operate. Of course, most lenders hate that idea. A personal guarantee is their safety net. So how do we convince anyone to lend us millions on a small business without a personal guarantee? The answer is we need a clever financing structure and likely a non-traditional lender. We also need to offer the lender something else to offset the lack of a guarantee. Spoiler, that's going to be a high interest rate and strong covenant. Let's walk through our plan step by step. But first, before we go on, I've got a quick ask of you. Like this video and subscribe to the channel so that more people can benefit from this content. Also, if you'd like to buy your first or your 100th business or commercial property, click on the link in the description and book a call with me. I'll work alongside you to get a great deal done. Now back to the video. Our first move was to tackle the down payment problem by getting the seller to finance a big chunk of the deal. After building good rapport and trust with the owner, we negotiated a seller note for 30% of the purchase price, $2.7 million. This was a game changer. In simple terms, the seller agrees to accept $2.7 million of the 9 as an IOU, which we will pay him over time rather than in cash at closing. That immediately slashes the cash needed at closing by 1/3, and it gets better. We secured very favorable terms on the seller finance loan. The interest rate is 5%, which is quite low for a junior note, and it's amortized over 30 years. So the scheduled payments are small, like a long-term mortgage. On top of that, no payments are due for the first 2.5 years. We negotiated a payment holiday to give the business time to stabilize under our ownership. The first 30 months, we pay the seller $0. After that, we'll start making monthly payments as per 30-year amortization, but then there's a balloon payment in year 7. So to recap, the seller note is interest only for 2.5 years with interest accruing to the principal. The finance term for this is PIK, payment in kind, then tiny payments for 4.5 years, and finally whatever balance remains is due in a lump sum at the 7-year mark. We can always refinance or pay it off early if the business performs well. It's important to note that the seller note is fully subordinated to any senior loan we get, and this means that the seller's note sits behind the senior lender in priority. The senior lender will have a first claim on the business assets and cash flow. The seller only gets paid according to the note terms as long as we're in compliance with the senior loan. We even included a clause that any terms needed to satisfy SBA rules for seller standby will automatically apply, just in case. More on why SBA loans weren't an option shortly. In practice, subordination and the 2.5-year deferral give the future senior lender a lot of comfort. Their debt will be serviced first, and the junior seller won't see a penny until the senior is fully paid. By getting the seller to finance 30%, we effectively solved the equity injection problem. The seller's $2.7 million note serves as the bulk of the down payment from a deal structure perspective. Some lenders even view seller notes as a form of quasi-equity, since it's risk capital behind them. Now we only needed to raise 70% of the purchase as a senior loan. So the challenge now is finding a lender for $6.3 million who will not ask us to sign a personal guarantee. Finding a 70% LTV loan without a personal guarantee. Initially, we approached a couple of commercial lenders. Think small banks or finance companies with our deal. We found one willing to do a 70% loan to value for $6.3 million. Pretty standard leverage for a business acquisition of this profile. But there was a catch. They required personal guarantees from the buyers. This is typical. Most lenders, when lending to a private company of this size, want the owners on the hook. We had to walk away from this lender, despite otherwise decent terms. For us, taking on a recourse loan defeats the purpose of our diversified strategy. It was back to the drawing board to find a truly non-recourse loan. That means our hunt shifted to specialty lenders outside the traditional local bank and SBA channels. It's important to note SBA 7A loans are off the table for us. Many business buyers use SBA loans because they finance up to 90% of a purchase at reasonable interest. But by SBA rules, all 20% plus owners must personally guarantee the loan. It's non-negotiable. No personal guarantee means no SBA money, period. So even though an SBA 7A could theoretically have funded this deal with as little as 10% down, it wasn't an option because of the guarantee requirement. If you're curious, SBA may work for many of you if you don't mind the guarantee. SBA loans also typically have a 10-year term and currently something like 11% interest, and they might have accepted the seller note as part of the equity injection if it's on full standby. But again, the guarantee requirement made it a non-starter for us. But you guys should check that out. We also knew that most traditional banks would respond similarly. For a $6 million plus loan to buy an asset-light business, a bank would normally want a combination of collateral and guarantees. In our case, the property management business has very few intangible assets, no real estate, minimal equipment. The collateral would essentially be the contracts and the future cash flows of the business, which is a bit abstract for many banks. Without hard assets, a bank's only fallback is the guarantee. So we didn't waste time chasing conventional bank loans that were almost certain to insist on recourse. So we turned our focus to alternative lenders who might do a cash flow loan on a non-recourse or limited recourse basis. But it's important to remember that in this game, there is no free lunch. If a lender isn't getting a personal guarantee, they will want something else to compensate for the high risk that they're taking on. Typically, the trade-off for non-recourse is higher interest rates, stricter covenants, and maybe additional collateral or fees. We're prepared for that. Our mindset is that we'll pay more to protect our downside. It's worth it. Now let's spell out the give and take when you ask for a non-recourse business loan. Higher interest rate. Expect to pay a premium on the interest. The lender's taking on more risk since they can't chase us beyond the business. So they'll charge accordingly. In practice, that means a rate possibly in the high single digits to low double digits. By contrast, a fully recourse loan backed by personal guarantees might be a few points cheaper. We're okay with this. We expect something around 10 to 12% interest for a non-recourse loan of this size. A bank recourse loan or SBA might have been, say, 7 to 8% in today's market. Generally, cash flow acquisition loans range 9 to 13% interest in the current environment, and we might be on the upper end due to the no guarantee and intangible collateral. Debt service coverage covenants. We're open to a debt service coverage ratio, DSCR covenant, to reassure the lender. A typical DSCR covenant might require that EBITDA of a debt service is greater than or equal to 1.25x every fiscal quarter or year. That means the business must be producing at least 1.25 times the cash needed for loan payments, or we're in breach of the loan. This covenant gives the lender an early warning and control mechanism if the business performance deteriorates. In our case, with $3 million EBITDA and an expected debt service in the range of $1 to $1.2 million, we'd have a high DSCR of 2.5 to 3 times. Other covenants and terms. Well, the lender may impose other covenants, such as limits on additional debt, restrictions on paying dividends to us as owners before the debt is serviced, and maybe requiring lender approval for large acquisitions or capital expenditures. Non-recourse lenders will often want to monitor the borrower's financial health closely. We're ready to live with some of these restrictions, since our plan is to focus on organic growth and debt repayment in the near term anyway. Collateral. Naturally, the loan will be secured by the business assets. The lender's only recourse is the collateral, so they'll take a first priority lien on all assets of the company. That includes the management contracts, any equipment or vehicles, the company's accounts receivable, intellectual property. Also, they'll likely take a pledge of the equity, shares of the company. If we default, they can seize 100% ownership of the business. Essentially, we're putting the entire business on the line, which is fair. If we fail to pay, we lose the business. We will also agree to things like key person life insurance or continuation of management provisions, since the lender is betting on the cash flow continuing under our ownership. Now, what I call the bad boy guarantee. Even in non-recourse loans, it's standard to include a personal guarantee for certain bad acts. So fraud, gross mismanagement, misappropriation of funds. If we lied on our loan application or siphon off money illegally, the loan would become recourse as a consequence. We have no issue with this. We're going to run the business ethically, of course. As one investor friend says, non-recourse isn't a license to be stupid or dishonest. It's protection against bad luck, not bad faith. So now, with our willingness to sweeten the pot, pay a higher rate, and operate under covenants, we set out to find the right lender. To secure $6.3 million without a personal guarantee, we thought about several options. Here are the main financing options we explored and our thoughts on each. Option 1, SBA 7A loan, which I've already mentioned is not an option for this deal because of the personal guarantee. Option 2, traditional bank commercial loan. We thought about approaching medium-sized banks for a conventional term loan. In some lender middle market deals, banks lend to companies based on cash flow without owner guarantees, but those are usually businesses with $10 million plus of EBITDA or strong asset collateral. For a $9 million transaction of a small business with mostly intangibles, every bank we spoke to said they'd require a personal guarantee. They also typically would want to see some cash injection. They'd been uncomfortable with 0% buyer equity and only a seller note as equity. Given these hurdles, we didn't pursue a traditional bank loan further. It just didn't fit our no money down, no recourse requirement. Option 3, DSCR-based loan. We learned about certain lenders offering DSCR loans, which are common in real estate investing. A DSCR loan bases credit decisions on the debt service coverage ratio of the asset rather than the borrower's personal income. Some mortgage lenders extend this concept to real estate heavy businesses, essentially looking at the properties or business's income as the sole basis for lending. In theory, our target business with $3 million EBITDA and steady cash flow could qualify for a DSCR-based loan. The coverage is strong at 2.5 to 3 times, and some DSCR loan programs are non-recourse or limited recourse by design. But many DSCR lenders focus on properties like apartment buildings or portfolios of rentals, where there's tangible collateral to foreclose on. Our business, while it generates cash, doesn't own the underlying real estate. It's just managing it. We found that some commercial finance companies might treat the recurring management fee stream almost like an asset to lend against, but this is a niche approach. We kept DSCR lenders as a possibility, figuring we'd need to present the business almost like a property management contract portfolio that throws off rental-like income. This option might require a higher interest rate, probably 12 to 13%, and possibly a lower LTV, maybe 50 to 60%. But we explored to see if any would go to 70% LTV non-recourse. Option 4, mezzanine debt or private credit funds. This is probably the most promising category. Mezzanine lenders and private credit funds specialize in cash flow-based loans for acquisitions, especially in the lower middle market. These lenders are used to financing buyouts where the loan is secured by the business and backed by its cash flow, not by personal guarantees. In fact, one of the main selling points of mezzanine financing is the no personal guarantee requirement. The mezzanine debt is inherently riskier. It's often second lien or unsecured behind a senior loan, so they compensate with higher interest, often in the low to mid-teens %, and sometimes equity kickers like warrants. In our case, since we're talking about the only senior loan, we might actually get a unitranche structure. Basically, a single loan that blends senior and mezzanine risk in one package. Private credit funds could potentially fund the full 6.3 million as a one-stop non-recourse loan. Mezzanine providers also usually allow interest-only periods for very flexible amortization, sometimes even no amortization until maturity, to accommodate cash flow needs. We like this option because these lenders understand leveraged buyouts. They structure a lot of deals where a management team or an independent sponsor like us buys a business mostly with debt. In fact, some mezzanine funds advertise that a company can be 100% financed with debt if it has strong cash flows, without the owners investing equity, as long as the business's value and cash flow support it. Our business at 3x purchase multiple has a lot of cash flow relative to the debt, so it might fit their model. The downside of mezzanine or private credit is cost and complexity. So that means higher interest and more lender oversight, and possibly requirements like taking a board observer seat or equity warrants. But we keep full ownership and control. So we were comfortable pursuing this, and we've started talks with a couple of mezzanine and private credit funds. Option 5, hard money or bridge loans. Another path was to use a short-term bridge lender or hard money loan. Hard money lenders are common in real estate. They lend fast and with fewer questions, but at higher interest rates, often over 12% plus points and short duration, like 6 to 24 months. If we absolutely needed to close the deal quickly with no personal guarantee, a bridge lender might step in, using the business assets as collateral. We'd then have, say, a year or two to refinance into something more permanent. Once we've owned the business for a while, a bank or SBA might refinance it if the personal guarantee issue could be revisited, or if we bring in a guarantor down the line. We looked at 1 or 2 specialty finance groups that do high leverage acquisition bridge loans. While this could work, the cost is very high and it adds refinancing risk. We ask ourselves, what if we can't find a permanent loan in time? For example, one could imagine a hard money loan at 15% interest only for 18 months, non-recourse. It gets the deal done, but chewing up 15% interest is 945K a year on 6.3 million, about 1/3 of the EBITDA just in interest, not even touching principal. It also puts pressure to improve or flip the financing within a short period. We kept this as a last resort option, if all else failed, but preferred a more medium-term solution. Option 6, revenue-based financing. More recently, fintech lenders have emerged that offer revenue-based acquisition financing for online businesses and other cash-flowing companies. For example, there's one that will fund up to 80% of an acquisition for e-commerce, SaaS, or similar businesses, and charge a repayment based on a percentage of revenue over 5 years, no personal guarantee required. The effective interest rate is higher than bank loans, but it scales with how the business performs because payments are a fixed share of monthly revenue. We thought about whether any revenue-based lender or fintech could fund this deal. Our target is not a pure online business, of course, it's a services company, but it does have recurring revenue in the form of management fees. We reached out to see if these kinds of lenders would consider it. The feedback was that while they typically focus on digital businesses, some are open to it. They're open to high margin, steady revenue companies like ours. The limitation was usually the loan size. Many of these platforms max out at a couple $1 million, so revenue-based financing could potentially cover a portion of our $6.3 million needed, but not all. We could in theory stack a revenue-based loan for say $2 million and then find another $4.3 million elsewhere. This complicates the capital stack and would require coordinating 2 lenders. Unless needed, we prefer dealing with one primary lender. Either way, it's an innovative path you should be aware of. There are lenders who lend on cash flow and take repayments as a percentage of revenue with no personal guarantee, although usually for smaller deals. So keep this in mind for your deals. Option 7, bring in an equity partner. Finally, it's worth mentioning we could have solved the financing by bringing in an investor to contribute cash in exchange for equity. If, say, an investor put in 10%, 900K, or 20%, 1.8 million of the price as equity, that would reduce the debt needed and impress lenders. The investor's cash could effectively replace some of the debt, likely getting us better loan terms. This is something we're keeping in the back of our minds. There are a few folks who want to come on board. Ideally, we'd keep all the equity to ourselves. After thinking through all these options, we decided to pursue low middle market private credit funds and mezzanine lenders to fund the entire $6.3 million senior loan on a non-recourse basis. So essentially a unit tranche loan that covers 70% LTV. If that means the interest rate is a bit high, so be it. The business can support it. And if we need to split it into a senior plus mezz piece, we would do that. Maybe a senior lender at 50% LTV and a mezz lender providing the next 20%, together making 70% total. In one case study we found, the financing advisor was able to arrange a combination of a first mortgage and a small mezzanine loan to reach about 70% leverage on a non-recourse basis for a real estate deal. In our case, since there's no real estate, the analogy is a first lien cash flow loan plus a second lien top-up if needed. Although we know of several funds that could do the whole loan themselves, essentially acting as both senior and mezzanine with a blended rate. So we began talks with a handful of non-bank lenders. This included an SBIC fund that specializes in mezzanine loans, a family office that does direct lending, and a boutique private credit firm. We also engaged a loan broker who has a network of lenders for acquisitions in the $5 to $20 million range. Sometimes having an advisor or broker who knows which lenders to tap is extremely helpful, because the private lending world is quite opaque. With that, we moved to structuring the terms of the loan we'd accept and highlighting the strengths of the deal to get it approved. To attract the right lender, we basically had to structure a loan that looks safe and lucrative from the lender's perspective, despite being non-recourse, of course. Here are the specifics of what we're planning and proposing in term sheets. So firstly, loan principal, which is $6.3 million, 70% of the $9 million purchase price. This results in a leverage of 2.1 times EBITDA. Since 6.3 divided by $3 million EBITDA is 2.1 times. That's a relatively low multiple. Many leveraged buyouts go out to 3 times, 4 times or higher EBITDA. In fact, using mezzanine capital, companies can often raise total debt up to 4 to 5 times EBITDA comfortably, as long as cash flow is steady. So at 2.1 times, our senior debt is quite conservative. This low leverage ratio is a key selling point to lenders. The business is throwing off a lot of cash relative to the debt burden. Interest rate. We're targeting somewhere around 10 to 11% annual interest on the senior loan. This could be structured as a fixed rate, say 11%, or a floating rate, say SOFR plus 6 to 7%. Either way, that's significantly higher than a bank would charge if we gave a personal guarantee, but in line with what private lenders charge for cash flow deals. As a sanity check, 9 to 13% is a common range for acquisition financing loans of this type, so we're right in there. At 11% interest, the annual interest expense on $6.3 million is about $693,000. That is only 23% of our $3 million EBITDA, a very comfortable margin. Even adding some principal payments, the debt service should be under 40% of EBITDA, which means a strong DSCR of about 2.5 times. Lenders love a high coverage ratio. We could even afford a higher rate if we had to, say 12 or 13%, and still be okay. But of course, we'll negotiate for the best rate possible. Term. We prefer a medium-term loan, roughly 5 years. Many private loans are 5-year term with options to refinance or extend. We don't necessarily want to be locked in a very long loan at a high interest rate, but we need it long enough that we're not forced into an immediate flip refinance. 5 years is a typical horizon. It gives us time to operate, grow EBITDA, and then perhaps refinance on better terms, or even pay it down aggressively. If a lender insisted on a shorter, say 3-year term, we'd push for an option to extend or refinance. If they offer longer, say 7 years, that could be fine too, though usually these lenders like a 3 to 5 year exit. Amortization. Here we want to strike a balance. On one hand, lenders like to see the loan principal being paid down over time, amortized, as an added safety. On the other hand, heavy amortization increases yearly cash outflow and can strain the business or limit growth. Given our seller notes has no payments for 2.5 years, our strategy is to keep the senior loan payments relatively low in the early years as well. Ideally, interest only for the first 1 to 2 years and then start amortizing. One structure we are proposing is a 5-year term loan with a 25 or 30-year amortization schedule, essentially a balloon loan. That means the monthly payments are calculated as if the loan were stretched over 30 years, keeping them low, but at the end of year 5, the remaining balance comes due, a balloon. If we did a 30-year amortization at 10% interest, our annual debt service would be roughly 660K. That's interest and a tiny bit of principal, which is extremely comfortable, a DSCR of 4.5 times. Even at 12% interest, 30-year amortization, it'd be about 780K per year, DSCR of 3.8 times. The lender may prefer we pay a bit more principal, so we're open to say a 10-year amortization after year 1 or straight line 10-year amortization from the start. A 10-year at 11% would make annual debt service around 1 to 1.1 million, which is still a DSCR of 2.7 times. So anyway you slice it, the cash flow covers it easily. We'll tailor the amortization to ensure DSCR of over 1.5 times, even in downside scenarios, and also align with the seller note silent period. Likely we'll do interest only for year 1, and then perhaps begin amortizing in year 2 or 3 when the seller note is about to kick in, so that the combined outflows remain manageable. Covenants. As we covered, a DSCR covenant of 1.25x or maybe slightly higher will be part of the deal. We'll also have a standard financial reporting requirement, monthly, quarterly financials to the lender, and likely a covenant to maintain the company's good standing, pay taxes, insurance, etc. Possibly a leverage covenant might be included, so not incurring more debt beyond a certain multiple of EBITDA. Given the strong cash flow, we don't anticipate issues complying with these covenants. We'll ask for some flexibility, like curing a DSCR breach if it happens, for example, injecting a bit of cash or having a grace period to get back in compliance. But that depends on the lender's policies. Also, we expect a covenant that restricts distributions to us as owners if we're not meeting certain thresholds. Often a lender will say no dividends or distributions out of the company if doing so would drop your DSCR below X, or if you're in default. This just ensures we don't drain the cash and jeopardize their loan. We're fine with that. We plan to reinvest earnings into growth and paying down debts in the initial years anyway. Collateral and security. The loan will have a first lien on all business assets. We'll sign a stock pledge agreement of giving the lender the right to take ownership of the company's shares if we default. Essentially, the business itself is the collateral package. There isn't real estate to mortgage, but if the company owned any vehicles or equipment, those would be collateralized too. The lender may also ask for a blocked account or lockbox arrangement, where customer payments go into a controlled account that ensures debt service is paid before we freely use cash. This sounds a bit extreme though. Most lenders only do that if the borrower starts to trip covenants. We will negotiate on this point as it affects operational flexibility. Given the DSCR is strong, we might avoid a lockbox, but we may agree to set up a debt service reserve account, for example. Keep 3 months of debt payments in a reserve account just in case. This is a show of good faith that we won't run the business down to $0 cash and risk missing on payment. Fees and closing costs. Private lenders often charge an origination fee or points, 1 to 2% of the loan. On 6.3 million, a 2% fee is 126K. We've budgeted for some closing costs like this. We'll also be paying legal fees for loan docs, possibly ours and the lenders. All told, financing a deal like this isn't cheap. But again, it beats shelling out millions in equity or risking millions in personal liability. We also considered offering the lender some warrants or an equity kicker to sweeten the return, which is common in mezzanine deals. But our lenders so far haven't asked for that since the company is already high yield via interest, and they usually reserve equity kickers for riskier or even very high leverage deals. We prefer to avoid giving up equity if possible. So to recap, the loan we're assembling is something like $6.3 million, 5-year term, 11% interest only for 12 to 24 months, then amortized on a 10-year schedule, with covenants, DSCR 1.25x, and a first lien on the business, no personal guarantee. This structure aligns incentives well. The lender gets a solid return and a claim on a business with plenty of cash flow, and we get the growth potential and upside of the business without risking personal ruin if it fails. Having a plan is one thing. Getting the yes from a lender is another. Here's how we're going about actually securing the non-recourse loan. Packaging the deal for lenders. We prepared a detailed information package on the business, essentially a lender presentation. This includes the company's financial history, 5 years of income, statements, cash flow, etc. Lists of assets and contracts, details on customer retention, which is important since contracts can cancel. We showed historical cancellation, churn rates, which are low, and our business plan post-acquisition. We highlight the strong EBITDA margins and recurring revenue. We also emphasize that at a 3x EBITDA purchase price, the valuation is low enough that the lender has a huge cushion. In an absolute worst-case fire sale, a property management business with hundreds of contracts around the country could likely be sold to a competitor or investor for at least 2 times EBITDA, which is $6 million or more. The lender is owed $6.3 million, so the exposure is roughly equal to the fire sale value. Not that we ever want to test that, of course, but it's comforting to them, demonstrating ample coverage. We present multiple scenarios, base case, downside case, to the lenders. In the base case, the business continues at its $3 million EBITDA with modest growth. The DSCR stays very high at 3x plus. In a downside case, say EBITDA drops 20% to 2.4 million. For instance, maybe some rentals leaves or pricing pressure. Even then, the DSCR on our proposed debt would be around 2x or better. That business would still cover debt service with room to spare. We show that even if a recession hit the travel industry and EBITDA fell by 1/3 to $2 million, the debt could still be paid, 1.5x DSCR, assuming we tighten up costs. These scenarios give comfort that the risk of a default is low and that we as sponsors are conservative operators. Remember, a lender who isn't getting a personal guarantee is effectively underwriting the business as if it were a standalone asset. So they look very closely at the cash flow durability. We've compiled data on the short-term rental market resilience and how this company performed during past downturns. It survived COVID-19's travel freeze, for example, and bounced back strong, which is a huge de-risking data point. Management experience and skin in the game. One concern a lender might have with no buyer equity is, will the new owners just walk away at the first sign of trouble since they have no money invested? Well, we address this head on. My partner and I emphasize our experience and our track record in the hospitality and property management space. This isn't our first rodeo. Collectively, we've operated and turned around similar businesses. Our reputation and future deals depend on making this a success. We may not be putting in cash, but we are absolutely investing our time, our effort, our reputation. Also, the fact that the seller is leaving 2.7 million in on a standby is a strong vote of confidence. The seller believes the business will generate that to pay him later. That aligns the seller with us and indirectly with the lender. The seller wants us to succeed and might even consult or assist during the transition to ensure we do well since it's got money on the line for years. When we close the deal, the sources and uses will look like this. The senior lender wires 6.3 million to the deal escrow. Our seller gets 6.3 million in cash at closing, along with any cash adjustment for working capital, plus a promissory note for 2.7 million as we've gone over. We take ownership of the company. Going forward, the company's cash flows will first go to servicing the $6.3 million loan, interest, and later principal. The seller note doesn't start drawing cash until year 3, so for the first 2+ years, we can also use cash flow to invest in growth, hiring a sales team, expanding to new markets, without worrying about paying the seller. By year 3, ideally the business has grown so EBITDA is even higher, making it easy to start paying the seller note on top of the senior debt. By year 5, when the senior loan matures, we expect to refinance it, maybe even with a traditional bank or SBA loan at that time, if we're willing to consider partial guarantees or just a new private loan on improved terms. Or maybe we'll have enough cash to pay it down. We might also consider bringing on investors then, once we've improved the business value significantly. We have lots of options then. The key was getting the deal done now without using our own cash. For us as buyers, the outcome is great if all goes according to plan. Ultimately, if we maintain that $3 million EBITDA, we could be looking at, say, $1 million plus of free cash flow annually with no money out of pocket invested. That's essentially an infinite return on investment. Over 7 years, we could theoretically pay off a big chunk of the debt from cash flow alone, all while paying ourselves some and growing the business. The seller will get his 2.7 million in the end. He's being paid interest, so he's happy. The lender will earn hefty interest and get paid off or refinance, so they're happy. And we will own a more valuable company outright. It's a win-win-win. One very important thing to note. This is a no money down deal, not a no money deal. This is a leverage deal, and with high leverage comes risk. If something went really wrong, say a regulatory change outlawed a short-term rentals in the region, gutting the business, then yes, we and the seller could lose the business to the lender, and the lender might then auction off whatever's left to recover what they can. We'd walk away with nothing, and our reputation would suffer, and rightly so. But we purposely chose a business with resilient characteristics and structured the debt conservatively to mitigate that. In our view, the downside, which is losing a business we didn't put cash into, is acceptable compared to the upside, owning a cash cow that can grow with essentially none of our cash at risk. This is a case study showing what's possible with creative deal making. This kind of deal isn't common. It's like a unicorn in the small business world, but it is doable with the right approach. We hope this deep dive gave you insight into how to structure high leverage acquisitions. If you're looking to do a similar deal, focus on finding solid businesses, be flexible and creative in financing, and don't be afraid to ask for arrangements that conventional wisdom says are impossible. You might be pleasantly surprised at what a motivated seller or an innovative lender is willing to agree to. No money down doesn't mean no effort. You have to put in the work to line up the pieces. But for those willing to hustle, it's a powerful way to build an empire without starting with a fortune. If you found value from this deep dive, like this video and subscribe to the channel so that more people can benefit from this content. Also, if you'd like to buy your first or your 100th business or commercial property, click on the link in the description and book a call with me. I'll work alongside you to get a great deal done. Thanks for watching. Stay tuned for more updates from me. Until then, happy deal making and keep thinking outside the box in your own entrepreneurial ventures.